Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Ryan McCormack, factor and core equity strategist over at Invesco, for a review on weekly performance in the Qs. And of course, we'll take a look at valuations within the Nasdaq-100 index as we are heading into earnings. Ryan, it's great to see you as always, and still Nasdaq-100 outperforming the other indices this year.
Yeah, great to see you too, Jill. And it was another good week for QQQM and QQQ, up 3.13%. Outperformed the S&P 500 up 1.85%, and the S&P 500 value up 1.45. It's been a pretty good start for the year, right? You see QQQ and QQQM up 5.67%. That figure is outperforming the S&P 500 up just over 4%, and S&P 500 value up around 5.22%. Over the past week, we saw largely positive market reaction to Thursday's CPI report. Showed a month-over-month decline of 0.1% and a year-over-year advance of 6.5%, which is the first sub 7% year-over-year increase since back in November 2021. So I think the street continues to believe that the Fed may become less hawkish with kind of this perceived progression against inflation. And we're looking at the Fed funds future showing the target rate reaching a high of under 4.9%, which is lower than the Fed's projections. Today, we saw producer prices for December fall more than forecast on a month-over-month basis. They climbed less than anticipated on a year-over-year basis, but markets kind of being dragged down by weaker than expected retail sales figures, showing a 1.1% month-over-month decline. So, better numbers on slowing inflation, but weaker numbers in terms of a perceived soft landing.
Right, and let's talk about earnings projections as they're going to start to kick in earnest over the next week or two. Of course, the earnings picture looks much different than it did in January 2022, since we've seen a massive valuation reset.
That's exactly right, and I thought it would be interesting to take a look at where we've come from, and even looking at where we are this year versus the same time last year, ahead of these larger earnings reports. And we're kind of kicking off next week with the heavyweights: Microsoft on the 24th, Tesla on the 25th, Meta on February 1st, Apple and Alphabet on February 2nd. So as always, kind of a condensed look at some of the largest holdings within QQQ and the Nasdaq-100. But I think as we're looking at this chart, looking at the trailing 12-month PE and the forward PE on the Nasdaq-100 index, you can really see that significant drop over the course of 2022, and that's something that you and I have talked about at length. With higher rates, with concerns around economic growth, investors were certainly cautious around NDX multiples and the prospects for growth in this challenging economic environment. At this point, however, following that slide that we saw over the course of 2022, we're roughly in line with the 10-year average for both trailing 12-month price to earnings ratio as well as forward. On a trailing 12-month basis, we're at 24.94. That's against the 10-year average of just under 25.5. And the forward, we're looking at 21.73, just under the 10-year average at 21.94. So essentially, if you look at the graph, we're kind of trading where we were in the early stages of the pandemic. To get more specific, looking back 1 year, this time 2022, we were at a trailing 12-month multiple PE of 35.83%. So we're at a 30.4% discount to that figure today. On a forward basis, we were at a 27.8 forward PE. Right now, we're at a 22% discount to last year. So, I think as we look forward through this round of earnings reports, markets are going to pay attention for resilience, especially since generally, calendar Q4 comprises the largest earnings and sales quarters for a lot of these companies, and certainly any commentary on the effects of inflation, whether it be higher inflation or signs of retreating inflation on their business lines, and of course guidance to the extent that these companies provide it will be paramount.
Yeah.
Just for some context, you look at these companies, over the last 12 quarters, Tesla, Microsoft, and Apple have surprised to the upside from an earnings perspective in 11 of 12. Google, 9 of 12, and Meta, 8 of 12 quarters. So it'll be interesting to see if they can kind of follow suit with what we've seen over the last 12 quarters.
Yeah, and Ryan, that was such a great illustration that your chart showed, because the past 2 years you had to recognize that wasn't going to be sustainable forever, and certainly it's come back down in line to what we've seen from there was 2013 and beyond in the chart that you saw up until we got to the moves that we saw with COVID. But let's talk about what happened more near term. What sectors were contributing to Nasdaq 100 performance?
Yeah, so we saw this large avoidance of sort of growth-oriented sectors last year, right? And I think a lot of that drove that valuation sell-off that we saw. Well, this year is a little bit of a different story thus far. We saw large contributions to relative outperformance from the overweight technology sector and overweight consumer discretionary sector relative to the S&P 500. We also saw a positive contribution from healthcare, despite its underweight allocation relative to the S&P 500. The sector within QQQ outperformed its counterpart. We also kind of saw last week's rally being accentuated by a move away from some of the defensives, sectors that outperformed last year. 7 of 8 sectors in QQQ were positive for the week, consumer staples being the only one in the red. And within the S&P 500, only 2 sectors ended in negative territory, the aforementioned consumer staples and utilities, which again are both considered defensive. So, perhaps the market's showing a little bit of optimism for a softish landing and looking at some of these growth-oriented names based on relative valuation.
All right, Ryan, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.